We begin with breaking news. The Bank of Canada is holding its key interest rate steady at 5%. Today's decision is in line with what most economists had predicted. The central bank stood pat on the rate in October and in November, while some expect rate cuts coming starting next year. Well, financial planner Alan Small joins us now with his take on the latest interest rate decision. Probably no big surprise on your end, but when we talk about the potential for interest rate cuts in the new year, how deep into the new year are we talking, do you think?
It's a good question. And some people are thinking first quarter. I'm more leaning towards maybe end of second quarter or mid-year. I think it's going to depend on how things go, right? How growth numbers look in this country. If things start to deteriorate pretty quickly, you could see rate cuts happen sooner. Obviously, if the economy continues to muddle along, perhaps Tiff Macklem and Bank of Canada will be hesitating a little bit more to raise interest rates.
Obviously not the news that for people who have borrowed money or have a variable mortgage, they were hoping to see a rate reduction and pay a little less money. But do you think this was the right decision for the Bank of Canada at this time?
Yeah, absolutely. When you listen to what the banks are saying, and the banks just reported earnings, our big banks, in the last couple of weeks, and really all the banks are saying the same thing. They're saying they're setting aside more money for bad debt, for credit losses. They're seeing that the loan demand is shrinking. So they're seeing overall it's costing a lot more money for the banks to keep people's money in their savings accounts. And so banks are struggling right now. Banks are struggling because they're not seeing growth. We're not seeing growth in our country, right? GDP negative for the third quarter.
Well, to stimulate growth, people need more money. And when we look at some of these variables and indicators, we had unemployment just tick up again, up to 5.8%. And historically, sometimes when that happens, when unemployment goes up, we start to see interest rates to go down to stimulate the economy, potentially stimulate the housing market. That's not the case here. What do you think that says moving forward?
Well, I think that says the Bank of Canada is getting what they want, right? Remember, they've said all along that unemployment would have to tick higher for them to see inflation come down, and it's still not at their target of 2%. So where do we stand on that? Well, they have a balancing act, right? On one hand, they don't want to see the economy and our country go into a recession, but on the other hand, they want to see inflation coming down. And for them to attack inflation, as they've said all along, it's going to take perhaps a higher unemployment rate to bring things down, to slow things down, slow down the economy. So with an unemployment rate getting closer to 6%, once upon a time it was closer to 5%, that's what the Bank of Canada wants. And sometimes people don't understand that because all of us, we'd like to see everybody working, making money, spending money. Bank of Canada wants the opposite at this point in time because they want to see inflation get closer to their 2% mark.
For someone who's potentially looking to borrow money, whether it's they're doing major renovations, they want to have a big purchase, maybe pay off their vehicle, some of these people might be sitting on the sidelines. They want to see those rates come down a little bit lower. Do you anticipate that, if we do see a rate reduction, that we will start to see things starting to heat up, that we will start to see more people who maybe have been sitting on the sidelines when it comes to the real estate market wanting to get in?
Yeah, and I think that's the fear of the Bank of Canada, right? So I think they're going to still talk tough in their press conference. They're going to speak hawkishly because I don't think they want this market to heat up again because, again, they want to see inflation fall, not go higher. So I think they're going to speak tough. They're going to talk about how, well, right now we're holding pat, and if we need to raise rates, we will. And if we have to lower rates, we will at some point. But overall, I just think that the Bank of Canada wants to continue to see a slowdown. And for those that are waiting to borrow money, they're probably going to have to wait a little while because I don't anticipate a big drop in interest rates anytime soon.
And what about for the people right now who are struggling to pay those mortgage payments, especially considering the fact that we've had a series of about 10 or so rate hikes over the past year? For a lot of people, is there risk to the housing market based on the numbers and what we're seeing with some of these mortgages that people might just not be able to sustain?
Yeah, I think there is risk because we know that over the next couple of years, anybody who had a fixed rate mortgage, that mortgage is coming up for renewal, and you might see now your interest payments double or maybe even triple from where it was when you renewed maybe 3 to 5 years ago. So I think there is some risk in the housing market, and that is the fear, right? And that's what the Bank of Canada has to balance, the fear of a recession, a slowing housing market versus inflation. And they have to walk that tightrope. And they're trying to do that as best they can. And so this idea of what we call a soft landing, right? Having inflation come down, but still have the economy grow. That's where the Bank of Canada wants to be. The question is, can they achieve that? And many people believe they cannot.
Alan Small, we appreciate your time. Thanks for coming in.
Thank you.